Welcome to Shaken Not Burned, a cocktail of solutions for a sustainable future. I'm Felicia Jackson.
And I am Giulia Bottaro. Each week we interview experts to talk about parts of the sustainable transition and what you and your business need to know to succeed.
Sustainability is complex and constantly evolving, and it can be hard for a business to adapt and remain competitive.
We are here to help you learn all about the changing economy and the ongoing transition.
So join us as we explore the concepts and the tools you need to plot a course for a sustainable future.
Welcome to a new episode of Shaken Not Burned. In our current economic system, a company's primary responsibility is to maximize profits for its shareholders. Shareholders' interests should take precedence over those of other stakeholders, but this comes at a cost. Essentially, return on investment is prioritized, but the consequences are socialized. For example, air pollution caused by industry affects public health, which the government is likely to pay for. The roots of this ideology can be traced back to economist Milton Friedman, who argued that corporate executives' main duty is to their employers, the shareholders. But what happens if we prioritize stakeholders instead? I discussed this issue with Rob Carpati, partner and senior advisor at the Blended Capital Group. Thank you so much, Rob, for joining us today.
Thank you very much for inviting me. I've been looking forward to the conversation. It's a really important topic, and it's directly tied to a lot of my work at the Blended Capital Group, where I focus on mining and artisanal mining in particular. So thank you.
Amazing. Yeah, really looking forward to the chat. So why don't we start with you explaining the difference between shareholder capitalism and stakeholder capitalism?
So the way I think about it, a business doesn't exist in isolation. It's part of an ecosystem. It's sitting beside a community. It's in a region with the government. It has whatever stakeholders around it, both social and environmental. So when you think about stakeholder capitalism, it's recognizing the reality those relationships matter. They need to be fostered. They lower risk. They create opportunities for a business. So thinking about those stakeholders isn't about charity. It's about smart business and aligning long-term future based on relationships. Shareholder focus, on the other hand, tends to be a less focus on stakeholders and more focus on near-term profit. Let's figure out how to make money. Shareholders are the one stakeholder that's primary over the others. So at the end of the day, the challenge with shareholder capitalism is that if you ignore other stakeholders, there tends to be degradation in value over time as relationships go in the wrong direction. Risks increase and value is lost.
And are there differences between shareholders and their behavior? So, for example, I'm thinking of pension funds, which may have a bit of a longer term view compared to maybe retail investors. Yeah, can you talk a little bit about that?
So there's a wide variety of shareholders out there. Of course, there's as wide as society as a whole. There's everything ranging from short-term speculators, private equity funds, public companies, pension funds with longer term, and so on. And there's also impact investors who are socially motivated and try to derive positive impact socially or environmentally. In my work in mining and artisanal mining in particular, I talk to investors a lot. And part of the conversation centers around what does mining mean from a community? What does mining mean for the environment? What does mining mean financially? And how do you tie that into the different characteristics of investors? So it turns out different investors care about different parts of things. Some care about, I want to make money, and that's the only thing that matters. Others care about, I want to care about the long-term investing value slowly. I want to treat people well and improve social outcomes. I want environmental hygiene, and so on. So all of that ends up being in play with different groups. And when you think about artisanal mining and what I do, all of those enter the conversation by definition.
Do you mind explaining what artisanal mining means?
Absolutely, thanks. So there's large mining companies, we all know them, Barrick Gold, BHP, Rio Tinto. There's 7 million people who work in large mining companies, and they do business everywhere around the world. Artisanal miners are small-scale prospectors. They're largely informal. They're largely in underdeveloped countries, not mechanized, and there's 45 million of these miners. So basic opportunity, and when you think about stakeholder capitalism, it's a natural fit. A basic opportunity is to professionalize these miners, equip them, train them, introduce proper equipment into their process, better work practices into their process, and change relationships so that they're equitable. So all of that, it's going to cost money to do that. Investors need to be at the table, but it's going to deliver money. Stakeholder relationships fundamentally change. Productivity fundamentally changes with it. And it ends up being sustainable around a massive sector that's tens of millions of people.
So artisanal miners are individuals that know that there will be a certain mineral in a certain place and go there, or is it more like smaller companies?
They're individuals or small groups of people who, for the most part, are informal. They're not in companies. They're small-scale prospectors. They're often members of communities in the region, and they're traditional miners. There's gold over there. They mine it. Or there's critical minerals over there, copper, cobalt, something else, they mine it. A lot of the time, it's the combination of poverty that engages people into it because it's really hard work for not a lot of money. Lack of competing options is another reason people become these miners. And for some, it's maybe I can do this and find the mother lode and get rich quick. But for the most part, it's a combination of poverty and lack of other opportunity. But changing the dynamics and creating companies or cooperatives for them and giving those companies or cooperatives the ability to exert influence fundamentally improves the dignity of work and the productivity of work.
Understood. Going back to the main topic of the conversation, it seems that shareholders are really the most powerful people in our economic system. So why do we prioritize financial return over everything else?
Well, like you said in your introduction, Milton Friedman, half a century ago, talked about that. And he said the rights of shareholders, the rights of owners trump all. And my personal perspective, and I'm going to be fairly blunt, it's a short-sighted way of thinking about things. Of course, shareholders matter. Of course, they should make money. We live in a capitalist reality, but businesses operate in communities and engage a variety of stakeholders. So not thinking about those or not thinking about them sufficiently in the long term ends up eroding businesses. And in some ways, it's also a driver of short-term focus where people want to make money. They want to make it now, this quarter, this year, this 3 years, instead of sustainable businesses that are going to deliver this decade and this quarter century, which is more aligned with stakeholder focus, where there's broader alignment and broader relationship towards long-term value.
It sounds quite unstable for a company as well if you've got investors backing you for maybe a certain amount of quarters and then they leave because they made their gains. It feels like as a company, if you're able to attract long-term backers, then you've got more certainty, right?
A long-term focus always beats a short-term focus at the end of the day. Absolutely. And you think about the different stakeholders that are involved in business. Well, you've got employees. So you treat people well, your people, your greatest asset, and you're going to attract top talent and they're going to be motivated to do right by you. You treat them less well and that benefit goes away. What other stakeholders? Customers. So at the end of the day, the people buying your product, if they're aligned with you, if they know you're treating them fairly, they're going to be interested in having long-term loyalty-based relationships with you. And then all the other myriad stakeholders that are out there. So it takes time to develop those relationships. It's about trust. It's about sustaining proper dialogue, respect, and remembering that there's multiple points of view, which is hard to do when the only thing you care about is shareholders. So you think about it in the mining world, you've got mining in often in pretty remote places, often in pretty underdeveloped places. And a mining company comes in, they hire people, they're neighbors of the community, and they develop whatever relationship they develop. If they think about this relationship from a long-term value point of view, they're going to have collaborative productivity. That's a good thing. If they think about it from a short-term point of view, because that's their focus, and maybe some shareholders like that, then they have conflict risk, PR risk, legal risk, just risk, because they're doing things that don't necessarily deliver social license over time, which is basically earn trust.
Yeah, I'm thinking that there are a lot of jurisdictions where miners have mines that are stalled because the local communities have protested for a long time, or maybe they are facing court battles. So they get there, they spend a lot of money to explore and develop the project, and then they're not actually producing anything because they didn't prioritize the stakeholders.
Precisely correct. And we've seen it over and over in large projects. First Quantum in Panama just the other year, massive copper project, which went in the wrong direction because there wasn't broad-based alignment. The Tia Maria and Las Bambas projects in Peru, massive, by coincidence, copper again, had problems and shutdowns and issues, active conflict, because community relationships weren't fostered. So absolutely, it's fundamental to conflict-free value, to optimizing value over time. Then you think about it from an artisanal mining point of view, and the notion of professionalizing these folks who are really an extension of nearby communities is core to broader engagement and core to broader value that makes sense to communities, miners, and all other stakeholders over the course of time. So absolutely.
So in the end of the day, it's also in the best interest of shareholders to foster these relationships with, positive relationships with stakeholders, right? So why are they not pushing for it? I mean, obviously it's very generic, but why is this not more of a thing?
Well, it's a mentality thing. It's a culture thing. So a pure shareholder focus is short-term, more short-term to a degree. So, I'm in, out, I make my buck. Who cares about the long term? That's one thing. The second thing is it's maybe easier. I'm running my business. I'm driving it towards shareholder value. It's easier to do that than to think about the myriad stakeholders that are around the business. What does a group of relationships look like, and how do you foster them? So you need to be progressive. You need to be multidimensional in your thinking to focus more on a stakeholder-based approach. But you're precisely right. It creates more value over time. It sustains more value over time compared to the easier, shorter-term, pure shareholder focus.
So, if you're a company in any sector, I mean, you're specialized in mining, so perhaps we can talk about that. Are there any ways in which companies can identify their stakeholders and then establish a dialogue with them?
Absolutely. So let's separate artisanal and large-scale mining for a second. But if you're a large-scale miner, and most of these folks get it to a certain degree, but practices are inconsistent. Some companies do a great job. Some companies do a, frankly, very poor job. But it all starts with doing the work, rolling up your sleeves. Who do I interact with? Whose land am I beside? What are the community components? Who else do I interact with in my value chain? What am I doing to the environment? They're all stakeholders. And then when you think about those stakeholders, it takes time to sit down, talk with them, understand them, because you got to listen actively. And then based on understanding their wants, needs, fears, and values, you can develop solutions that are good for you and good for them at the same time. Artisanal miners often share land with large-scale mining companies, so they're incidentally a key stakeholder group for large-scale mining companies as well, because they're physically there and they're an extension of the community. Now, ASM itself, when you don't think so much about large-scale mining companies, to a degree, it's the same premise, but it's a different starting place. You don't have a formalized business. You're an extension of the community. You're putting the right governance in place. And as you do that, you're thinking about the business relationships you need. Who's your intermediate? Who are going to be the people in your cooperative or company, your employees all of a sudden? How do you relate with the community where you likely come from? So you're defining it more from scratch as a traditional activity compared to a large-scale mine, which comes in from far away, gets a land concession, and needs to do a whole bunch of research to think about what's there.
It sounds like all these things that you've described also work for other sectors beyond mining. So who owns the land I'm operating in or nearby? So who are the local communities? Who are my customers? Who are the intermediaries? I think it sounds quite universal in a way. If you're a company in any sector, there are already a lot of people that are around you that you should interact with?
It's completely universal. Absolutely. You, no matter what industry you're in, and I used to be in a large multinational for a few decades earlier in my career, you've been invited to a community because you have a manufacturing operation or a warehouse or an office or something there. You have employees, you have customers, you have civil society interested. You have potential impacts on the environment, carbon, pollution, this, that, and the list goes on. So you need to be thinking about what are those impacts, who cares, based on who cares. Well, those are the stakeholders. Some are more important than others, because there's a closer natural relationship with more influence, and you can consider them more material. And with the ones that are more material, you can focus your energy. There's dialogue and focus solutions that make sense, solutions to both you and to them. If you don't, well, who knows what's going to happen when. But legal risk, various forms of conflict risk are a reality that you face.
Governments as well.
Absolutely. Of course they are. And different levels of government. Because you might have municipal, you might have state, you might have federal levels of government. They all have public policies. You're somehow delivering something positive or negative relative to those public policies. So engaging governments, having the proper dialogue, thinking about them as critical stakeholders is essential. If you're a mining company, for instance, is there sustainable development that you can trigger? If you're artisanal mining, does professionalization support sustainable development? Yes. Is there infrastructure potentially involved that needs to be set up? Yes. Do those things align with public policy? Well, of course they do. So you're spot on.
Talking about impact, it sounds easier to measure the return on investment for shareholders. How do you usually measure the impact on stakeholders?
It is easier to measure the impact on shareholders, which is one of the reasons why shareholder focus is so strong. But at the end of the day, every stakeholder you need to think about differently. Sometimes it's you've signed an agreement, an impact benefit agreement, for instance, and you're going to live to it and measure against it. Sometimes it's emissions of some kind of pollutant into the air. You're going to minimize it. You're going to measure it. Sometimes it's making sure that you're paying a fair wage. Of course you can measure it. So some things are easier to measure and some things are harder to measure, but it all boils down to concrete strategies with concrete deliverables that you think about how to measure on an each individual basis.
So you talked about these deliverables and these agreements that a company may sign with its stakeholders. So who's got the responsibility for this, to implement these agreements and sort of hold companies accountable?
The company. Well, everybody as defined in the agreement, I suppose. But at the end of the day, insofar as the company is the guest on the land of the community, it's the company that's responsible for ensuring that it delivers what it says it's going to deliver. And conversely, that if other stakeholders have something to deliver that's part of the agreement, that's kept an eye on as well.
So when we talk about stakeholder capitalism, it's not just a monetary value that a company provides to its stakeholders, right? You mentioned less pollution, wages. I mean, I suppose fair wages are monetary, but development. Can you provide maybe a few more examples on this?
Yeah, by definition, stakeholder capitalism, you're thinking about stakeholders. It can be something in mining, as simple in mining, for example, as you're going to build your facility with something called a tailings dam in this direction to the left versus that direction to the right, because there's a different impact with the prevailing winds or something else that keeps the community safer if there's ever a breach and no smell if there's a breach. There's no money involved there, but by shifting the location, all of a sudden there's a positive impact to the community. There could be something like employee retention, because if you're treating people well, they're going to want to stay. You're going to want to be able to hire better people, like top talent kind of people, because they want to work with you. So the list goes on. But basically, by thinking about stakeholders, there's various soft value that's created, which translates into tangible value. Because, for instance, if you can hire more top talent, your company's going to do better. because they're going to exert their ability.
Can you think of a success story in stakeholder capitalism, a company, a sector where things are working well?
There are tons of individual stories where companies done this done this well. There are also very specific stories in mining that have engaged communities very well, or artisanal miners that have been professionalized very well. In that side, there are organizations like Alliance for Responsible Mining or 11 Sources that do an incredible job with that. We both know, unfortunately, the preponderance of the business world is more shareholder focused, which is part of why we have the challenges that we're seeing across the world today, because it's not sustainable.
Yeah, absolutely. How can companies or maybe even shareholders impose on management to foster these relationships?
Choice. Shareholders are the owners, and shareholders can pretty much tell their company that they own, they want to foster these relationships. They want to spend money on these relationships and see lower risks and higher returns. It's choice. But to make that choice, you have to have a mindset that you want to make that choice. You need to understand the fundamental value that stakeholders deliver. You need to understand that value optimization is a long-term concept by definition. It's not this quarter, it's this decade, let's say. And as soon as you understand that stakeholders matter, they move the bar on value and risks, and that's a long-term construct, you're going to want to influence your company and the companies that you own in engaging for success. And there is all sorts of reporting out there around this, ESG reporting, sustainability reporting, which at least to various degrees tell you how thoroughly companies are doing this. But for large institutional investors, you got to go below the covers of the reporting to understand the reality and really drive the reality. A great example, an absolutely great example, the Church of England Pension Fund with Adam Matthews, who's the head of it, has done a lot of work on tailings dams in mining. And by being an active investor, he's engaged the industry, which has led to the development of a standard around how to manage these tailings dams to reduce safety risk. It's going to save lives. It is saving lives. And that's also forcing companies to live to it, because now as a standard, investors know if they're living to it or not. So active investors, especially larger institutional ones, have a whole lot of power because they're the owners at the end of the day.
Yeah, I think we've seen it in a lot of cases. Activist investors make their voices heard and are also able to involve other investors in that company and sort of push for what they want at AGMs.
Yeah. I mean, if you're a part owner of a company, because publicly held companies are broadly held, if you have a case that you want certain behavior and you drive a shareholder resolution and you engage other investors in that and you articulate why it makes sense to the company, therefore why it makes sense to those other investors, you can bring others along. And sometimes, depends on individual realities. Sometimes it works better than other times. But we both know we've seen lots of successes of progressive shareholder resolutions that have made a difference.
Going back to the concept of a short-term view, I've read a lot I've often read the fact that CEOs are not in power for a long time, and so maybe that's why they push for the short-term solutions that will maybe increase their pay package and make the short-term shareholders happy. Then I'm reading here the statistic by the Global CEO Turnover Index that says that last year the average tenure of outgoing CEOs was 7.4 years. To me, 7.4 years doesn't sound that short. What do you make of this?
So everyone does what they're paid to do, including CEOs and CFOs. So if you're paid based on short-term performance, delivering earnings per share this year, share price going up this year, that's going to be your focus. So that's thing number one. If you're paid more based on long-term and options that exercise in a certain number of years, you might have a longer-term focus because you're going to listen to your bosses who are the shareholders at the end of the day via the board. 7 years is not a short period of time. What you do this year will make a difference in 5 years or 7 years and will directly impact your pay. But for you to think about that as a long term, You need ownership structures and pay structures that facilitate that. Instead of every year, hit my earnings per share number and grow by, pick a number, 7%. You're going to do that, and the year after you're gone, the company falls down, which we've seen as well. Actually, General Electric was a great example of that back in the day, where Jack Welch did a fabulous job of growing it till the minute he left, and then he ran it for the short term. And after he left, the company's share price went boom, because there wasn't much left that was long-term oriented.
I feel there is a bit of an obsession on share prices when really I don't think that a growing share price is necessarily the number one signifier of good health of a company.
Stock markets are reactive. In theory, share price is the current value of a future earnings stream. Okay, fine. But how do you know? If you're overplaying short-term, I did well this year, therefore I'm going to whipsaw earnings or share price up 15%, or I did badly this year, so I'm going to whipsaw share price down 15%. Well, it's no longer a true reflection of a future earnings stream brought back to today's dollars. It's more speculative. And we see that. It is more speculative. That's a problem. Shareholders also have incomplete information, they see what statutory reporting requires them to see, and they also see what companies choose to allow them to see, but that's not necessarily everything. So that's a problem, and it's an agency problem in a way, where the C-suite may have their own interests at heart more than they have the interests of the owners at heart, because they know they're leaving and retiring in 3 years or whenever.
You mentioned risk earlier, and you just mentioned financial reporting now, which makes me think, should sustainability reporting, therefore, a risk sort of view on the externalities that will affect the company, should it be incorporated with financial reporting? Because a lot of the listed companies publish their sustainability report as a sort of nice thing once a year and so on. Well, obviously the financial reporting is mandated. But then, as you said, the financial reporting doesn't provide a complete picture.
Yes, I think there needs to be much stronger, much more consistent sustainability reporting. There needs to be very, very, very real clarity on what's your materiality grid? What are the material risks and what are you doing about them? And show me your performance around those stakeholder by stakeholder. It doesn't exist in a consistent mandatory way today, which makes it harder for investors to make choices. So for instance, if you're working on a mining project, which you're just starting and it has a 15-year timeline till a project goes from pre-exploration to operations, or even longer than 15 years, how does an investor know what you're doing with your community? Well, they know what you tell them, but you might not be telling them. So they really don't know at the end of the day unless they dive really deep, which is a barrier to entry. So to me, the notion of more consistent, mandated, stringent sustainability reporting directly integrated into financial reporting makes complete sense.
The title of this episode is Moving from Shareholder Capitalism to Stakeholder Capitalism. What do you think we need to do that?
So awareness and culture change. So from an awareness point of view, look, stakeholder capitalism isn't about charity. It's about smart investment. It's about engaging in relationships that deliver collaborative value over the course of time. You got to understand that. It's got to be awareness. It's long-term oriented by definition. In mining, folks talk about earning social license, and some companies do a great job, others less so. So culture change, the notion of valuing the long term, the notion of, stakeholders aren't a headache that I have to deal with. They're part of a business process that I own. And as part of a business process that I own, I need to engage respectfully, I need to listen actively, and I need to develop solutions collaboratively. Can't just tell people what to do because I feel like telling people what to do. So it's a combination of awareness and education on the one side, in my view of the world anyway, combined with a culture shift on the other side.
One of the critiques of capitalism is that it's focused on profit growth at all costs. And this doesn't go well with the concept of sustainability and, limiting our environmental impact. So do you think that stakeholder capitalism would focus on something else beyond just profit growth?
Completely. So, yeah, today's world, and we're seeing things play out in the United States, for instance, at the moment, that are pure shareholder focused and have the potential of creating a very dystopian reality from a stakeholder point of view. The whole point of stakeholder capitalism, or if you want to think about regenerative capitalism, is that it's more long-term oriented. It's more stakeholder inclusive. It's more diverse. It's more dynamic in terms of changing stakeholder realities. It's prone to greater equalities. It's still capitalism, of course, because we live in a capitalist world and we want to live in a capitalist world, but it has a different set of assumptions around relative value and how value is generated through a collective matrix of very diverse stakeholders.
So what makes it capitalism, and in what way distances itself from the traditional view of capitalism?
Well, you're still making money, but you're thinking about more than just making money. You're thinking about what am I doing to the environment? What am I doing to the community? What am I doing to my employees? What am I doing to whoever else? And that's good for you to think about those things, because if you don't treat your community or your employees well, then you're not going to do very well as a business in terms of profit either. For instance, back to the first quantum project in Panama, the last in mining, or the Las Bambas and Tia Maria projects in Peru, which we mentioned a few minutes ago, and there are many others like this. If there's just no money to be made for anyone at the end of the day when stakeholder relationships go too far south.
Thank you, Rob, for this really illuminating chat. Is there anything else you would like to add?
Well, so I appreciated this opportunity. Thank you very much for inviting me. And I think in my work around artisanal mining and what I'm doing, which is bringing investors towards it and talking to different investors who think about financial value, but also social, environmental, and economic, the concepts we talked about are really important because it's thinking broadly about how value comes together, how we combine the dignity of work with productivity, with positive outcomes across the board. So thank you very much.
Thank you, Rob. This also makes me think that we are all stakeholders of some company out there. So it's really something that we ought to think about. So thanks again for the great chat today, and thank you to our listeners for following us. Don't forget to subscribe to our newsletter and check out our social media. See you next week.